Good afternoon, this is Sean Golden with Golding & Golding, here to provide a brief follow-up to a presentation we did a few weeks ago about citizenship-based taxation to help provide some examples of how the process works. Unfortunately, the United States works differently than most other countries when it comes to taxation. Individuals, and this is just for individuals, right? Corporations, entities are a little bit different. For individuals, the U.S. taxes individuals who are U.S. persons for tax purposes on their worldwide income. We're going to provide some examples, but let's first go through who is considered a U.S. person for tax purposes. So, when talking about individuals, there are three main categories: U.S. citizens, lawful permanent residents, foreign nationals who meet the substantial presence test. The latter category, substantial presence test, essentially is a counting days test. It primarily impacts foreigners who are living in the United States. Either they're here maybe on a B1, B2 travel visa, an EB5, E2 investment type of visa, H1B, L1. If you're in the U.S. for a significant number of days over a 3-year period, using a 1-to-1, 3-to-1, and 6-to-1 ratio, because remember, the IRS doesn't make this easy for you, then you qualify for the substantial presence test, and unless an exception applies, which we'll get to in a moment, you're taxed on your worldwide income just as if you were a U.S. citizen or a lawful permanent resident. So let's go through some very kind of straightforward examples. Example 1. A U.S. citizen is living in the United States with foreign income. So taxpayer lives in the United States, works in the United States, pays tax in the United States on their U.S. income. They also invested in some foreign country, so they have interest income or dividends from a foreign country. Maybe it's a current account generating a small amount of interest in the UK. Maybe it's India with fixed deposits or whatnot, and there's significantly more income, a higher interest rate. Even though those are treaty countries, and even though that income may be taxed in the foreign country, because the person is a U.S. citizen, in other words, a U.S. person for tax purposes, they're taxed on their worldwide income, and that includes foreign income. Another U.S. citizen lives abroad, and they have foreign income. So taxpayer Jane lives in a foreign country, and she earns all of her income from the foreign country. She pays a significant amount of tax because the tax rate is higher in this country than it is in the United States. Guess what? Since Jane is a U.S. citizen, she's still going to file a U.S. tax return and report her worldwide income, including all of the foreign income. Now, she may be able to apply the foreign earned income exclusion on her earned income. She may be able to apply foreign tax credits for credits she already paid in the foreign country on that income, which is true of the prior example as well. When a person pays tax overseas, then sometimes they will have credits available to offset their U.S. taxes on the foreign income. But from a baseline perspective, U.S. citizens are taxed on their worldwide income, whether they live in the United States or overseas, whether the income is sourced in the United States or overseas. Next example, there's a lawful permanent resident in the United States with foreign income. This is super common because maybe Dave is a foreign person who moved to the United States, was here on a visa, then became a permanent resident. Dave lived and worked in a foreign country before, so he has a significant amount of income from the foreign country and investments. Well, Dave still has to report that income on his U.S. tax return, even though it's generated in a foreign country, even though the accounts and the investments were made before he became a U.S. person. They predated when he first came to the United States. Well, from a U.S. tax perspective, that doesn't really matter. Dave still has to include that income on his U.S. tax return. Now, example 4 is a lawful permanent resident who lives abroad with foreign income. Same concept applies, tax on worldwide income, so the foreign income is taxable. But if that person is living in a treaty country, then the individual may be able to claim treaty benefits to be treated as a foreign person or a non-resident for U.S. tax purposes. In that case, the foreign income would not be taxed on their U.S. tax return. It's not worldwide income. Instead, taxpayer files a Form 1040-NR while making a treaty election 8833, and then only has to pay U.S. tax on their U.S. sourced income. Finally, example 5, substantial presence test, like we mentioned. When a person comes to the United States on a visa, even if they're not on a visa, but commonly on a visa, and they stay a certain amount of days over a 3-year period, they're taxed on their worldwide income. So let's say someone comes here on an H-1B, they work, they have investments overseas, they make a significant amount of income overseas. Even if it's not significant, it doesn't really matter. They still have to report it, even though the person is not a U.S. citizen and not even a permanent resident. Now, as we mentioned, residents may be able to make treaty elections if you're here only. If you're taxed only on your worldwide income because you meet the substantial presence test, then there's the closer connection exception. There's some other exceptions as well. For some taxpayers who are only in the U.S. temporarily on a visa, even though they met substantial presence, it's as simple as not coming to the United States in the current year in 31 days. If you don't meet that threshold requirement, then you can't meet substantial presence in the current year, and so you're not taxed on your worldwide income. For taxpayers who are out of compliance, there's various compliance programs you can use to get into compliance. A lot of compliance, right? If you're willful, then the only option is really the voluntary disclosure program, VDP, which includes both offshore and domestic ever since they closed the OVDP, which is the offshore offshoot, back in 2018. Otherwise, if you're non-willful, there's various programs available. There's the streamlined procedures, there's the delinquency procedures, and there's reasonable cause. We got a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.